The US stock market hit a record high. Sai, I'm curious where it's going next. Hello, welcome to Money Matter. Today, we're going to talk about the all-time high in the US stock market. It's reached its highest point ever. Let me sing this song. You again. I want to know, Sai. I want to know what happens after an all-time high. Aren't you curious? Like when a stock reaches the highest point it's ever hit in history, then what? So what happens next? Earlier, PFO asked, hey, is an all-time high a good thing or not? All-time highs have both pros and cons. In this clip, I'll tell you stories from the past about why all-time highs can be scary, and I'll also share some historical data about why they can be good. But one thing I can say for sure is that an all-time high shows off the wealth status of the buyers, because it means you were able to buy the stock at the highest price in history that anyone has ever paid. Because if you look back at history, the five biggest, most famous market crashes all happened right after an all-time high. Let me show you a chart. Let's go back to 1930. That was the year the Dow Jones Index shot up and hit an all-time high for the first time. It really surged and reached its first all-time high. The market then crashed and dropped by 89%. The next time was in 1987, during the biggest global economic crisis ever, the Great Depression, Black Monday. The stock market plunged by 41% back then. Man, you could see people freaking out in front of Wall Street like, hey, the stocks are crashing. We have to sell our stocks no matter what. But when they couldn't sell their stocks, they'd rush to withdraw their money from the bank, but the banks were in the red too. It was a wild time. I'll tell you more about it if I get the chance. The third time was in 2000, the dot-com bubble. Stocks crashed, dropping 38% from their all-time high. In 2008, the subprime crisis, or as some people know it, the hamburger crisis, stocks fell 54% from their all-time high. And most recently, the COVID crisis. Stocks dropped by 38% from their all-time high. So where are we today? Right now, we're sitting at the all-time high of the Dow Jones Index, around 30,008 to 30,900 points. Hey, if that's the case, let's just sell everything. If you're holding stocks or if you don't have any, definitely don't buy. No way, not when stocks are at an all-time high. Wait. Let's listen to some more information first. Hold on, before we get into the arguments for why an all-time high might actually be good, let me take you back in history. I'll tell you some case studies about Japan, the US, and Thailand, how they've all experienced stock market peaks before, and then the markets collapsed. The market dropped, meaning it hit an all-time high and then crashed. Let's start with Japan, since it's the oldest case. Japan was a country that lost World War II, right? But after losing the war, the Japanese people had this incredible drive. They built up their industries and produced goods to the point where made in Japan became synonymous with premium quality, right? There was also an organization called Keiretsu, led by Toyota and other top Japanese companies. The government gave massive support to the Keiretsu, whether it was through printing. They supported the economy by lending out massive amounts of money, to the point where Japan's economy boomed like crazy. If you look at the Nikkei stock market graphs, it tells the story best. After the market crashed following the war, it grew by 4,500%. In 1950, after World War II ended, it started to rise, and it peaked in 1989 at around 39,000 points. Japan's GDP growth was at its strongest in 1960, growing by 11%, and in 1970, it grew by 6%. In 1980, it grew another 5%. Japan was once the world's second most powerful country, right after America, even though Japan's population was only about half of America's. But Japan's GDP was equal to 60% of what America achieved. This made the Japanese people, who had just come out of a war, really fearful of uncertainty. They became obsessed with investing. So where did they invest? They invested in the stock market, because investing in the stock market, the returns during that time, right, just kept going up and up and up. People had no experience at all with what it was like for the stock market to crash. Anyone who made money would just put it in the stock market, keep it in the stock market. The more money they put in, the more returns they got back. So they kept investing more and more, which made the Japanese stock market grow like crazy. Plus, they were exporting a lot too. But then, because Japan was catching up to America so closely, this happened. America totally cut them off at the knees by making a deal called the Plaza Accord. It was an agreement between America and European countries in order to weaken their currencies. It turned out that the US and the European countries really did see their currencies weakened, just as the agreement intended. But Japan's currency, Japan was the only country whose currency actually got stronger. This caused Japan to lose its competitive edge in trade and exports. Japan took a huge hit because at that time, the country relied heavily on exports. So when things stumbled, as soon as the stock market started to wobble, all the problems came to light. Massive borrowing, corruption, and excessive money printing. The Japanese stock market crashed hard from its peak of 39,000 points back in 1989. Just 4 months later, it had dropped by 30%. Then it kept falling, losing another 60%, making it an 80% drop overall. And that wasn't even the lowest point, because just when it looked like things might recover around 2007 to 2008, another crisis hit. Then came the global subprime crisis, the so-called hamburger crisis from America, and the market dropped again, falling from its all-time low of 7,500 points, which really hit Japan hard. So from its all-time high, the market crashed all the way down. It dropped by more than 80%, if I remember correctly. I can't recall the exact number, but basically it turned into a lost decade. And even today, Japan still hasn't managed to get out of that lost decade. After the all-time high, America also hit its own all-time high. Do you know when that was? It was right before the subprime crisis hit, when everyone was crazy about real estate, investing in houses, which kept driving up home prices higher and higher. Even though it didn't really reflect the actual state of the economy, whether the economy was good or not, nobody really knew. But people were flocking to buy houses, which drove up home prices. Even when some people started to struggle with their mortgage payments, right? The banks bundled together good debt and bad debt, creating a new package called MBS. And these MBS packages became hot-selling investment funds too, because once they changed the packaging, they ended up getting good ratings. They got an AA plus rating. S&P 500, well, S&P was the one who gave them that rating. That's why these MBSs sold so well. Now, did the banks know that those packages contained bad debt mixed in? Yes, they knew. Did many investors know there was bad debt mixed in? They knew too. But they thought the only way MBSs could fail was if millions of homeowners all decided to stop paying their mortgages at the same time. And then that's exactly what happened. After the real estate bubble formed and home prices shot up, right? One day, the subprime crisis hit, Lehman Brothers, the bank collapsed. The phrase too big to fail turned out to be a lie. And then, after the all-time high, when the subprime crisis hit, the market plunged, dropping by 54%. In Thailand, that period was around the time of the Tom Yum Kung crisis. Before the Tom Yum Kung crisis happened, right, Thailand pegged the baht at $1 to 25 baht for 6 years. In the first 4 years of that period, with the dollar peg, the stock market soared. Like, it went up a lot, especially in those first 4 or 5 years, up until 1990, even 1995. During that time, pegging the baht to the dollar made international trade really smooth because there were no worries about currency fluctuations, right? And it was even better for people who wanted to borrow money from abroad, because if you took out a foreign loan, you knew exactly how much you owed. No need to worry about exchange rates at all. Plus, the Thai government wanted to attract as much foreign capital into the country as possible. They needed to have enough foreign reserves to keep the currency pegged, right? So the Thai government did something called the Bangkok International Banking Facility, or BIBF for short. Basically, it was set up to make it easier for investors and banks to borrow money from abroad. And what did they do with that money? Well, pretty much anything they wanted. At that time, banks and big investors could borrow money from overseas at lower interest rates than they could get domestically. So they borrowed the money, but instead of using it to actually build businesses or create real economic value, they just lent it out again. That means it didn't generate any real economic value. There's one problem right there, right? And then for the smaller players, the regular folks who took out smaller loans, they just took the loan and disappeared entirely. They used it to invest in real estate for speculation. They didn't use it to create services or products that would add any real economic value. Real estate combined with an overwhelming amount of market speculation equals a bubble. And that's what led to the situation where the government didn't have enough necessary financial ammunition and resources. The money in the treasury was nearly exhausted and almost completely gone, dropping from over 30 billion down to just over 2 billion. So they couldn't keep the bot pegged anymore. And when the day came that they let the bot float, stocks at that time plummeted from their all-time highs, dropping as much as 89% into the negative. This is the scary thing about all-time highs. But let's get back to the present day for a moment. These days, when we talk about all-time high, we're usually referring to the US stock market because the Thai stock market isn't anywhere close to any kind of all-time high. So let's talk about the S&P 500, since it's reached its highest all-time high thanks to the Magnificent Seven stocks. There's 7 superstar stocks, which are all tech companies. To put it simply, out of the 500 companies in America, only 7 are actually making profits. That means the other industries aren't really doing all that great, right? If we just look at the top 4, Amazon, Microsoft, Nvidia, and they account for about 69%, almost 70% of the profits. They're really riding on the backs of the others, aren't they? So let me ask you this. So the question is, if US stocks can reach all-time highs because of tech stocks, then are tech stocks in a bubble right now? Because we're talking about all-time highs, right? And in the past, when all-time highs crashed disastrously, it was because of a bubble. So are tech stocks in a bubble right now? Let me give you this example. Let's compare Nvidia to a stock called Cisco back in 1999. Nvidia and Cisco are similar in that both stocks took 4 years, also returned over 1,000%. But with Cisco, after peaking with 1,000% gain, it crashed and dropped 80%. So people wonder if Nvidia will follow in Cisco's footsteps. Look at the PE ratio of both stocks. It shows if a stock is overpriced. Nvidia's P/E is about 26 or so. Is it cheap? No, it's not. But is it expensive? Well, if you compare it to Cisco, which people often use as a benchmark, when Cisco hit its all-time high and went up 1,000%, its PE was over 400. Now that's a bubble. So why isn't Nvidia considered a bubble yet? Maybe it's because the PE is lower, or maybe it's because Nvidia actually has solid fundamentals to back it up. Nvidia grew alongside Bitcoin when it became popular, right? When everyone was into it. When Bitcoin was booming, Nvidia grew a lot too. That was one big step for them. And now Nvidia is making cards specifically for AI development, and AI is advancing rapidly right now. That's the fundamental strength of Nvidia. Hearing it explained like this. So do you think it's worth investing at an all-time high? So let's listen to the other side of the story. I just want to say that an all-time high isn't the only factor that can crash the market. There are many other factors that can cause a market crash. Like I said, most of the time, an all-time high comes with a bubble, and that's when the market crashes. But the question is, are we in a bubble right now? I don't know, honestly. Looking at the whole market, I can't really tell. But if you break it down piece by piece, I don't think we're in a bubble yet. And an all-time high just guarantees that you're buying the stock at the most expensive price in history, at least compared to everyone else who's ever bought this stock before. But history moves forward, right? There's also another possibility. If you buy a stock today at its all-time high, it could actually turn out to be the best entry point. Let's say you could see the chart. Just imagine for a second, if you look 10 years into the future, and if it continues to keep climbing and delivers even better returns, right? According to Fortune, this all-time high is actually the 16th separate time it's happened since the start of the year. It's shown the main thing that usually follows after an all-time high. What happens more often than the market crashing is actually another cluster of all-time highs. So what usually follows an all-time high isn't a market crash, but rather a series of more all-time highs, one after another. For example, take a look at this chart. This chart shows the historical events that have caused the market to crash, what we call a market correction, which is when stocks drop by 10% or more, a decline of 10% or greater. Honestly, most people looking at this can barely tell where the market actually crashed. Like, where is it? Which part is the crash? It looks like the market just keeps going up. That's because this chart goes from 1950 to today, covering a huge period. If you look at the big picture, it's basically just a line trending upward. JP Morgan asked this same question. Is it worth buying stocks at an all-time high? Their research led to some interesting findings. Here's what the research says. Let's say, hypothetically, if someone bought stocks going back using data all the way back to 1988, if you bought stocks at an all-time high and held on to them, the green bars show your returns. The light green bars represent buying at any time, while the dark green bars show buying specifically at an all-time high. If you bought at an all-time high and held for 1 year, your average return would be 14.6%. If you bought at an all-time high and held for 3 years, your average return would be 50.4%. But if you bought at an all-time high and held for 5 years, your average return would be 78.9%. Wow, that's not bad at all. Do you know why that is? Because every single time stocks start to rally, heck, not just stocks, but things like Bitcoin too, whenever they start going up, everyone gets FOMO, afraid of missing out, and they all rush in. The media hypes it up, saying, hey, Bitcoin is going up, or hey, stocks are rising, and everyone's scared they'll miss the train. So people pile in, and that just pushes stocks, Bitcoin, or whatever asset even higher and higher as more and more people jump in. And on top of that, this year, the year 2024, is also a US presidential election year. If you look back at history, you'll see that nearly every single time there's a US presidential election, the stock market goes up by a significant margin. The only exceptions were in 2000 and 2008, when there were major global financial crises. And that's exactly when the stock market dropped during a US presidential election year. Even Michael Burry is the guy who predicted the subprime crisis back in 2008. He's the one who pulled off the big short, saying, hey, the subprime market is definitely going to collapse. And he made billions of dollars all by himself. People really trust what he does. Previously, he even tweeted things like, hey, the stock market is going to crash, it's going to fall apart, right? He even had to come out and tweet again, apologizing to everyone for encouraging them to sell their stocks earlier. So, in summary, everything I've just talked about, there are always two sides to it, right? You'll have to consider it for yourself. If you want to invest, I'm not saying that just because there are positives or negatives to an all-time high, that means anything for sure. Hey, the market could crash tomorrow, or it could go up. I just hope everyone keeps learning. And if you don't know where to start learning, come listen to Sai at Money Manga.